Hi, it's Neil here. You got me. And we're in week 5 now, so we're traveling through several of these chapters in Horngren, but really we're actually traveling through the landscape of where we learn the management accounting tools that are critical to executing strategy. And that's what we're about. It's not about remembering different figures and different tools and techniques. It's about understanding how we can use various tools and techniques to execute particular strategic decisions or directions of the company. Through this big picture, in the early weeks, what did we do? We looked in week 2, we looked at value engineering, and that was all about looking at the operational aspects of cost management through the lens of target costing, where we looked at functional analysis, where you position a product in the market. We looked at design analysis, how you actually put the product together, specifically design inside the product that the consumer doesn't always see, and process value analysis, where we're actually looking at the processes of manufacturing, the processes of delivering a service, and is there some way that we can cut out the meat so we're just left with the bone of that product or the service process, and we don't have excess costs being consumed in the manufacturing process or in the delivery of the service. We want to cut all the meat off the bone. And how did we do that? We tried to cut out the non-value added activities. What else did we try and do? We did root cause analysis, so cause and effect, and we're trying to work out, are there some things that we can stop doing that lead to problems down the track, or to defects, or to machines breaking down? Maybe we need to focus more on maintenance, maybe we need to focus more on training, maybe we need to focus on upgrading different facilities, for example. So it was cause effect analysis. And so this was very, very important. And finally, what was very important was to establish ways of measuring activity, that is, using performance measures. And so the more we measure things, the more visible the processes come to you, and then you're in a better position to manage those processes. So that's what we're about in week 1, week 2. Then we moved over to the other side, and let me get my nice pointer here. Over here we moved, here we go. Then we moved over in week 3 to custom profitability analysis, and this was all about activity-based costing, where the cost object was the customer, the cost object is the product, but looking at the customer as an example, because we didn't do it in basic management accounting and advanced management accounting, we want to apply activity-based costing to the customer. And then we are able to then consult and advise not only manufacturing businesses, but also service-related businesses, because service-related businesses don't necessarily have a product, they have a service, and they have customers. So what we're trying to do was understand how we can assign costs to different cost objects, which are customers, and in an activity-based costing approach. And so then there were costs consumed at the ordering level, there were costs consumed at the batch level, there were costs being consumed at maybe a departmental level or a sales region level, and then there were costs being consumed at the corporate level. And so depending on where those costs were being consumed, there were different cause and effect allocation bases that we used to assign costs to particular customers. So the whole approach was to try and get a more accurate allocation of cost to particular customers, so we can better make a choice about, well, do we keep the customers or not? Do we invest more in some of these unprofitable customers so they can become profitable in the future? do we decide to spend less in helping some of the unprofitable customers because, well, they're always going to be burdensome, they're always going to be nickeling and diming us, meaning that they're always going to try and get a discount from us, they're always going to be asking too many questions anyway. Maybe we don't want that type of customer. So these were some of the issues that we looked at, and that was in week 3. So really, these week 2 and week 3 were very operational. How do you actually save costs in week 2? Week 3, well, strategically, where should you focus your energies in developing particular customers, particular markets? And so having a greater sense of the profitability of some customers and the unprofitability of other customers can give you better information so you make a more accurate decision on where you direct your strategy in terms of going after certain types of customers. So that's what we're doing in the first week 2 and week 3. Very operational, very executional of strategy. Okay, so we weren't sort of just talking about strategy. We're actually talking about specific things we can do, specific decisions we can make when we more accurately allocate cost to particular cost objects. So that was the whole focus, decision facilitating. What we did in week 4 was actually service department cost allocation. And you're thinking, wow, more cost. Is this strategic management accounting or what? Well, actually it is. All right. You've got to get it into that strategic management accounting or strategy cannot ignore cost management. You cannot ignore it. You can't just keep on focusing on the revenues. Okay, it's not like we're a technology startup and we're just plowing through the cash all the time and we're focused on getting more markets and just getting more VC funding, like Xiaomi, 43 billion market capitalization based on VC funding, and let's just throw those phones out there and we don't care if we don't make a profit because it's only 3% profit margin. We understand that's the venture capital model, all right? So not all businesses are like that. Okay, once businesses mature and you want to sustain your value creation processes over time, you cannot just rely on venture capitalists just to keep giving you money. Okay, if you list, you're going to have investors wanting to get a return for their money. If you don't list, then if you're the investor yourself, you're the owner, then you want to get return for your efforts. All right, so cost management is very, very critical. Cost management is very, very critical to strategic management. And so that's why we're focusing on costs, how we can use costs to inform specific decisions that need to be made in the organization. So in week 4, when we talked about service department cost allocation, again, it's all about tracking the resource used by maybe production departments, assembly departments, finishing departments, or other frontline service departments. The resources, they not only consume labor and overhead and raw materials themselves, but they also use catering, they also use payroll, they use the accounting service, they use IT, yes. And so in that week, we actually focused on IT as the big elephant in the room that needs to be accounted for in some way or another. Why? Because the investment in IT is one of the largest investments that most companies make, other than in production, other than in service development, research and development. Okay, IT is the thing that keeps everyone together, that communication linkages between everyone. Now that a lot more is done online through the internet and so forth, IT is very big. So how do you account for that? Well, of course, you're going to account for it because you're going to get a bill in the mail. So it goes down as an expense. Or it's a capital investment, all right? So you're going to depreciate, and that depreciation is going to go into overhead. That depreciation is going to go into other parts of the profit and loss statement. We know that. But how do we account for IT in terms of making people accountable for the use of IT? So now we're moving from a decision facilitation type role of costing to a decision influencing type role of costing. And so in week 4, what we looked at was the 4 different purposes or roles of cost allocation, service department cost allocation. And at the very minimum, we were just thinking about, okay, if we allocate, even if it's just a rough single rate allocation, at least we can get some greater awareness that that service department exists. That service department is actually using resources. That service department costs the organization money. So this is the thing, all right? So that at a very minimum, when you get more awareness of that, then people will either appreciate that service department or they'll criticize it and say, well, you're wasting us too much money. You should be doing it this way. You should be doing it that way. If you don't do that cost allocation, people won't be aware, or they won't care to be aware. Well, why do I care? Why should I waste time giving feedback on a service department? You're not charging me, so I got better things to do. You got me here, right? But once you start charging different user departments for the use of the cafeteria, for accounting, for payroll, for IT, okay, suddenly the user department is going to say, you're charging me. Am I getting my money's worth for that service, you see? So by just creating that question in the mind of the user department forces more control and accountability inside the organization. You are actually influencing the user department to communicate with that service department on another level, you see. On the first level is the user department is ringing up IT. Hey, I need your help. Come and fix my email. Hey, I need your help. Come and fix my computer's crashed. Hey, I need your help. Come and fix up my payment system here. You with me here? But at another level, you got a service department allocation. We're going to allocate a cost for using all of this technical support, you see. And suddenly those costs start coming across and being allocated to me, the user. I'm going to think twice about, do I ring up and use that department or not? So now we've got another level of control. Okay, and so in these different levels of control can force us to think about whether we use the resource or not. And right down at the bottom of those 4 levels of control is the decisions about the capacity. How much capacity do we really need? See, once IT starts charging out its services to the user departments, the user departments are going to think twice about what they use, what they don't use. Now IT is going to have a better sense of planning for future capacity now that they know that the user departments are making a closer to an economic decision about how much of that capacity they are using. You see here? See, without that chargeback or without that service department cost allocation, you're going to get just people guessing, because user departments, I don't care, just put the money in, all right? Let's just get the best IT that we can get, all right? Because when I need it, I need it. If I don't need it, I don't need it. You see, so there's not much economics in that narrative that comes out from the user departments. But once a chargeback starts coming from the IT department to the user department, now the user department's going to think, well, maybe I don't think you're going to need as much capacity as you suggest you need, and if you can just invest at this level, I think that will serve our purposes for the next 3 to 5 years. And that, because the user department's going to talk in a more common sense way in terms of what costs am I going to be charged for using that IT department investment. okay, because I'm going to get a fixed charge at least for their big capital investment that the IT department makes. So I'm going to think twice about, well, if they ask me for how much capacity I need, then I'm going to be thinking, I don't want to say as much as possible. I'm going to be more considered and try and give a more accurate information of that capacity, you see. So at the very minimum, and the textbook talks about 4 different types of control, at the very minimum, what we're trying to do with service department costing is just to create this dialogue, to create this communication between user departments and the service department. That's what it's all about. And this improves coordination. It improves consistency of matching the capacity of the service department with the user department. It creates more accountability for the investment of the resources of the service department to match those of the user department, and to make sure the user department doesn't abuse these resources. And that's what it's all about. So when you think about it, when organizations are investing millions of dollars in IT, the average S&P 500 company is investing millions into IT every year, and that's allocated to various user departments. How we do these allocations is very, very important. Okay, it's a very, very important part of strategy execution. It actually keeps the organization communicating with one another. So there you have it. There's your first 1, 2, 3, 4 weeks of this unit. And I thought a lot about, how much costing do we put into a strategic management accounting unit? How much do we put in? Well, as much as possible, so you can understand the real role that cost allocations can play, the real role that cost management can play for the effective execution of strategy. Because at the end of the day, number one, you've got to manage costs. Number two, you need to get everyone in the organization communicating if you want to execute strategy. Okay, it's not like just picking a market and let's just go for that market. You've got to get user departments communicating with other parts of the organization, with the back office, with service departments. So you've got your communication going. So we've got cost management, we've got this communication, we've got this accountability from cost allocations. These elements are critical for the organization to sustain its business in the long run, and that's critical for strategy execution. So what we're going to do in the second half of this semester is to look at more the strategy of the organization. We're going to focus a little bit more on why the organization is existing, and we really focusing on the customer, why the customer buys from the organization. And so that's where we get into the really exciting part of the balanced scorecard. We will look more at the control systems that are used in the organization to get managers' attention, to control divisional managers and things like that. So we're looking more at control aspects in the organization, and we're looking more at measurement aspects in the organization. Not so much cost assignment, although we do cover that in about week 8, where we look at assigning costs to different activities in the production area, so we can better gauge our investment in quality enhancement initiatives. So we'll look at that. So as we go forward now, we're branching out into, okay, we know we have some profitable customers, some unprofitable customers, but what we're going to do after week 4, which is week 5 now, going into the second half of the semester, is we want to try and understand how we can align through measures, through KPIs, how we can align different aspects of the organization to achieve a common objective associated with the delivering a service or a product to a particular type of customer. And so we start this delivery of material under the first umbrella of the balance scorecard. So I hope you enjoy it. I hope you get some excitement of the coming weeks, out of the coming weeks, and I'll see you in the classroom. Thank you for listening, and bye for now.